Welcome to the Deep Dive. We're your shortcut to getting, well, really informed about a company's health and where it might be headed without drowning in data. Today, we're zoning in on a name you might know from India's infrastructure scene, Welspun Enterprises Ltd. They've been making some pretty strategic moves.
Yeah, so our mission for this deep dive is basically to unpack what really matters from their latest results. That's the Q1 FY26 unaudited financials, the review report, and their investor deck for the quarter ending June 30th, 2025. We promise you some maybe surprising facts and hopefully a much clearer picture of what all these numbers actually mean for their strategy. Okay, let's unpack this. Kicking things off with Welspun Enterprises Q1 FY26 performance. Let's start, big picture. Consolidated revenue from operations, what does that look like?
Okay, so that clocked in at 845 core.
Right, and how does that stack up against last year?
Well, that's actually a 9% dip compared to Q1 FY25. That was 930 core.
Okay, and total income, similar story.
Yep, consolidated total income also down 9%. From 960 crore last year to 871 crore this quarter. And the bottom line, consolidated net profit, PAT.
That landed at 101 crore. So again, a decrease, 8% down from 110 crore in the same quarter last year.
So revenue down, profit down, seems straightforward.
Well, here's where it gets fascinating, because despite those top line and P drops, year over year, the company actually reported an 8% growth in consolidated EBITDA.
Oh, okay. So earnings before interest, taxes, depreciation, amortization, that went up.
Exactly. It hit 208 crore, up from 193 crore in Q1 FY25. And maybe even more telling, their consolidated EBITDA margin, it jumped significantly.
Yeah, significant.
Record highs, actually. 23.9% in Q1 FY26. Compare that to 20.1% in Q1 FY25. That's a 377 basis point increase. Pretty substantial.
Wow. Okay. So less revenue overall, but much more profitable on what they did bring in. How are they explaining that?
Management points to two things: operational excellence and a superior project mix. Basically, they're saying they're running things tighter and focusing on jobs that, well, pay better margins.
Makes sense. It's not just about volume, it's about the quality of the revenue.
Precisely. And it's also worth noting, profit before tax, PBT, that stayed pretty much flat year over year. You had 154 crore. For the consolidated results.
Okay, helpful context. What about the standalone results, just for comparison?
Right, so standalone revenue, that was 604 crore. That's down 19% year over year, a bigger dip than consolidated.
And standalone profit?
Standalone PAT was 87 crore, only down about 2% from 89 crore last year. So a much smaller drop there.
Interesting. And the margin story on the standalone side?
Similar trend, actually. Standalone EBITDA margin also saw a nice jump, 19.5% this quarter versus 16.6% last year. That's, let me see, 289 basis points up.
So the margin improvement is happening across the board, not just from subsidiaries.
Seems that way. And just to quickly clarify for everyone, consolidated includes subsidiaries, associates, joint operations, the whole group picture. Standalone is just the parent company.
Right. So seeing margin growth in both, despite revenue dip, especially the standalone dip, it really raises that question.
Exactly. Why the lower revenue, but better profitability? Where's that coming from?
Which leads us perfectly into digging a bit deeper. Beyond the overall numbers, where did the growth, and I guess the decline, actually happen? Let's look at the segments.
Yeah, this is where the superior project mix idea really comes into focus.
Okay, so consolidated segment revenue for Q1 FY26, transport.
Transport was 317 crore. And yeah, that's a big drop, 43.2% down year over year.
Ouch. Okay, but what about the other areas? Water?
Now, water tells a different story. 310 crore, that's up strongly, 34.8% growth year over year.
Okay, that's significant growth. And tunneling and rehabilitation?
Even stronger, 218 crore. That's a huge jump, 52.7% growth year over year.
Wow. So a major decline in transport, but really robust growth in water and tunneling.
Exactly. And that's the key to the margin puzzle. The water and tunneling segments, they often come with, well, let's just say healthier margins. So even though transport revenue fell, the increase in revenue from these higher margin segments more than compensated in terms of overall profitability.
So that's the superior project mix in action, shifting focus.
Precisely. It's not just about the total value, but where that value is coming from. We should probably also mention there was a loss from discontinuing operations, about 13 crore this quarter compared to a 6 crore loss last year. That nudges the final net profit down a bit too.
Got it. And it feels like management's confidence is pretty high, especially looking at project execution milestones.
Yeah, definitely. They highlighted a couple of big ones. The Enta Samaria Road project, that's a landmark one, It just got its provisional completion certificate, the PCOD.
And that means?
It means it's basically operational, and crucially, they said it's on track for monetization by the end of this financial year. So potentially unlocking value there soon.
Okay, that's important. Any others?
Yes, the Mukarbachak Panipat, or MCP project. That one's now got its full completion certificate, so another one successfully delivered.
These aren't just ticks and boxes, are they? It's proof they can deliver these complex projects.
Right. It builds credibility for future bids and reinforces that operational excellence point.
So speaking of the future, what's the pipeline look like? What's in the order book?
It looks pretty healthy, actually. The consolidated order book stood at 13,665 crore as of June 30th.
13,600 crore. Okay, that's a solid base. Are they adding to it?
Seems like it. Management mentioned they're actively bidding for more work, something like 12,000 to 13,000 crore worth of additional projects in the next, well, month or month and a half.
So replenishing the pipeline aggressively.
Very much so. And it ties into their overall strategy, which the MD, Mr. Sandeep Garg, calls the 3G strategy.
3G. What's that stand for?
Growth, governance, and green. It's their framework.
Okay.
And underpinning that is this focus on an asset-light model and, again, operational excellence. They're spreading their bets across transportation, water and wastewater, and tunneling.
Using different models too, right? You mentioned HAM, BOT, EPC.
Exactly. HANM is hybrid annuity model, BOT is build, operate, transfer, EPC is engineering, procurement, construction, different ways to structure deals, giving them flexibility.
And that shift we saw in revenue segments, is that reflected in the order book composition too?
Oh, absolutely. It's quite striking, actually. Water now makes up 64% of that 13,665 crore order book.
64%. Wow.
Yeah. Tunneling is 14%, transport is down to 10%, and WML, that's Welspun Michigan Engineers, makes up the remaining 12%.
So that pivot towards water and tunneling isn't just current revenue, it's baked into their future workload.
Very much so. It's a clear strategic direction.
And just to connect that back for you listening, this diversification, this shift,
Yeah.
it's important because it makes the company less dependent on, say, just road projects. It lets them target these potentially higher margin areas like water infrastructure, which seems to be a big focus. Okay, strategy and pipeline look clear. What about the financial foundation? Let's look at the balance sheet.
Right. Always important. As of June 30th, consolidated net worth was 2,811 crore.
Solid. Cash position.
Pretty healthy. Consolidated cash and cash equivalents stood at 1,068 crore, so over 1,000 crore in cash.
Branded.
Gross debt was 1,446 crore, which means net debt. So debt minus cash was 378 crore.
Which is up a bit from the end of March.
Yes, it was 145 crore on March 31st, so it has increased, likely due to working capital needs or ongoing investments.
Speaking of investments, what are they holding? What makes up their assets?
It's quite a mix, supporting that diversified strategy. Total investments are around 1,344 crore. That breaks down into Actum road projects at 389 crore, road BOT projects at 134 crore,
Okay.
oil and gas projects at 474 crore. That's a significant chunk. Water BOT projects at 89 crore, Michigan Engineers, WMML at 237 crore, and then some other assets making up about 51 crore.
Let's pause on WML, Welspun Michigan Engineers. You said they're 12% of the order book. What's their niche again?
Right, WMML. They're actually a 60% subsidiary, been around since 1973. Their specialty is trenchless technology.
So digging tunnels or fixing pipes without digging massive trenches.
Yeah.
Exactly. Pipeline rehab, that kind of thing. It's pretty specialized work. They handle tunneling for pipes from, fairly small 450 millimeter up to large 350 millimeter diameters. They also do marine work dredging, underwater pipelines, and complex urban stuff like deep excavation pumping stations.
Niche, but sounds important for modern infra. How are they doing financially?
Quite well. In Q1 FY26, revenue was 208 crore, up 45% year over year. EBITDA hit 46 crore, up 28%. Good margin, too, 22%. And they've got their own order book of about 2,800 and 5%.
So a strong contributor within the group.
Definitely. And it fits that theme of specialized, potentially higher margin work.
You also mentioned the asset-light model and monetization. The Actis deal is part of that, right? Selling off some road assets.
Yes, exactly. That's a key piece of the strategy. They sold their 100% stake in the HAM road assets and 49% in the BOT toll road assets to Actis, a big infrastructure investor.
Has the cash come through? Mostly. They've received 244.5 crore out of the expected euro 59.5 crore from Actis so far. And there's another euro 269 crore due once the final equity transfer approval for that Mukarbachak Panipat project comes through.
So if you connect this to the bigger picture, They build assets, operate them for a bit, then sell stakes to recycle capital.
That's the essence of the asset-light approach for these types of assets, yeah. It frees up cash, reduces debt on their books, and lets them reinvest in new projects without carrying huge long-term assets permanently. It keeps them agile.
Makes sense. Okay, let's zoom out a bit now. The industry itself, particularly in India, you mentioned water is a big focus.
Huge potential there. I mean, think about it. India has roughly 18% of the world's population, but only about 4% of the world's freshwater resources.
That's a stark statistic.
It is. And currently, less than a third of the wastewater generated actually gets treated. So there's an enormous need for better water management and wastewater treatment infrastructure. It's a massive market opportunity.
And Welspun is trying to tap into that with new tech. You mentioned Welspun Smart Ops.
Yeah, they're highlighting this proprietary solution called SABRE. It stands for Bioengineered Solution something. But the key is what it does.
Okay, what are the advantages?
They claim some pretty impressive stats. Much faster deployment time, potentially needing only 1/10 the time of conventional systems, much smaller land footprint, maybe 1/5, way lower energy costs, again, maybe 1/10.
Wow.
Plus, potentially no need for big pumping stations or drain networks, and overall lower capital and operating expenses, CapEx and OpEx. If it delivers on those promises, it could be quite disruptive for wastewater treatment.
Yeah, so potentially a game-changer tech in a massive market. What's the overall size of the opportunity they see?
They estimate the total market across their verticals,
Right.
water, transport, tunneling, is around 6.6 trillion. And within that, their specific focus segments represent about 3.6 trillion. So plenty of room to grow.
Beyond the tech and market opportunity, what about the softer side? ESG, environmental, social governance, is that on their radar?
Very much so, it seems. They've published their first proper business responsibility and sustainability report, the BRSR. That's becoming standard disclosure now.
Right.
They also received a CCDP ESG rating, which basically scores their environmental performance, and they picked up 5 awards for health, safety, and environment HSE from government bodies and safety organizations for their project execution.
So getting external recognition for their practices.
Yeah, and their corporate social responsibility, CSR, focuses on what they call the 3 E's: education, environment, and empowerment. It suggests they're trying to build ESG into their core strategy, not just treat it as an add-on.
Okay, so bringing it all together, we've seen the Q1 numbers, the margin jump, the segment shift, the strategy, the tech, the ESG focus. What's the overall outlook? What are they guiding for?
Management's guidance for the full financial year, FY26, is for revenue growth of 15–20%.
15 to 20% growth. Okay. How does that compare to their recent history?
Pretty consistent, actually. Looking back, their consolidated revenue grew at a compound annual growth rate, CAGR, of 24% between FY21 and FY25. And EBITDA grew at the same rate, 24% CAGR, between FY20 and FY25.
So, strong historical growth track record. What about profitability over time?
Their average consolidated PAT margin, net profit margin, has been around 13% over the last 5 years. So that Q1 dip might just be timing. The full-year average has been decent.
And have they been rewarding shareholders along the way?
Seems so. They mentioned returning about 800 crore to shareholders through dividends and share buybacks between FY18 and FY25.
While still growing the company's value.
Apparently. Their net worth grew quite substantially from about 1,350 crore back in FY17 to nearly 2,700 crore, 2,689 crore to be exact by FY25.
So what this all means for you is, well, it looks like a company that's actively managing its portfolio, shifting towards areas it sees as more profitable and sustainable, like water and tunneling, even if it means some temporary dips in overall revenue.
Right. So just to sum up the key takeaways, we're seeing Welspun Enterprises navigate a significant shift in its business mix. While Q1 saw a top-line decline, there was really strong margin expansion.
Driven by that growth in water and tunneling.
Exactly. They've got a robust order book heavily weighted towards those strategic areas now, and this whole strategy is built around that asset-light model and, increasingly, a visible commitment to ESG principles.
Yeah, it's a clear pivot, which, raises an important question, I think.
Oh, one.
Well, in this infrastructure landscape that's changing so fast, you have to wonder, how might this strategic shift by Welspun Enterprises, this focus on higher margin segments and new tech like smart ops, how might that really redefine their competitive edge and ultimately their value to shareholders over the next few years? That's a great question to ponder. Definitely something worth keeping an eye on as their strategy plays out. A lot to think about there.